Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, candlestick patterns, reading the market's mood. And, today we are doing a deep dive into something that, honestly, it sounds super intimidating at first glance.
Oh, absolutely. It really does.
Right, but the crazy thing is that the most advanced, multi-billion-dollar algorithmic trading supercomputers in the world are currently making split-second decisions based on a visual trick that was literally invented by a Japanese rice merchant in the 1700s.
Which is just wild to think about when you frame it like that.
It really is. So our mission today is to demystify these candlestick charts for you. Because if you've ever opened a financial chart, you have definitely seen them. Those little vertical blocks, some red, some green, scattered across the screen with those little lines poking out of the top and bottom.
Yeah, and it just looks like absolute visual noise if you don't really know what you're looking at.
Exactly. But we want to show you how to use these charts to decode the emotional state of the market, really, without feeling totally overwhelmed by the complex data. And joining me to help translate all this into actual usable insight is our resident market expert.
It is great to be here, and I love that you brought up the idea of decoding an emotional state because, that is exactly what we're talking about today.
Yeah.
Yeah, because when you look at financial markets, it's incredibly easy to think of them purely as math, right? Just cold numbers moving up and down on a screen.
Based on algorithms and formulas and whatever.
Right, exactly. But the truth is, markets are made up of people, and people are driven by psychology, by fear and by greed.
Which we see in the market all the time.
We do, and candlestick charts are essentially this visual language that was designed to capture that exact human sentiment in real time.
Okay, but before we jump into the psychology of it all, we kind of have to understand what we're actually looking at on the page, because I think a lot of people see these charts and just assume they're a fancy bar graph. But according to the CFA Institute, candlestick charting is a very specific style of financial chart. And it's used for describing the price movements of everything from standard stocks to complex derivatives, which are basically just contracts betting on the future price of an asset and even currencies.
Right. It's incredibly versatile.
So what is the anatomy of one of these things? What does a single candlestick actually show you?
Think of a single candlestick as a visual summary of a specific period of time. And that period could be a minute, an hour, a day, or a week. It depends entirely on how you set up your chart.
Okay.
But no matter the time frame you choose, every single candlestick tells you 4 critical pieces of information: the opening price, the highest price reached, the lowest price reached, and the closing price.
The open, high, low, and close.
Exactly.
How do those 4 data points form that little shape on the screen?
Well, it starts with the thick part in the middle. That thick middle section is called the real body.
The real body, okay.
Right. The real body represents the difference between the opening price and the closing price. If the closing price is higher than the opening price, meaning the asset gained value during that time period, the real body is drawn as hollow.
Hollow, like empty in the middle.
Yes, or usually on modern screens, that's colored green or white with a black outline. It tells you immediately, visually, that the buyers won that particular session.
And if it loses value?
Then the real body is filled in. Traditionally, that's colored red or solid black. A filled candle means the opening price was higher than the closing price. The sellers took control and drove the price down.
Wait, so if the candle is green, why do we even care about the lines sticking out of the top and bottom? Didn't the buyers win anyway? What's the point of the rest of it?
Because the journey matters just as much as the destination.
Oh, interesting.
Yeah, those little lines poking out the top and bottom are known as shadows, tails, or wicks. They represent the extreme highs and the extreme lows of the price during that specific time period.
So it shows the volatility.
Exactly. Let's say a market opens and immediately drops significantly. That creates a long bottom wick. But then the market rallies all the way back up past the opening price, hits a massive high, and settles just below that high by the time the bell rings.
Wow, okay.
The real body shows you where it opened and closed. It shows who won. But those wicks show you the entire battlefield.
That makes so much sense.
They show you exactly how far down the sellers pushed it before the buyers fought back, and how high the buyers pushed it before the sellers resisted.
So a candlestick is essentially a quick daily diary entry of the market's emotional state. Was it a panicked red day or a triumphant green day? And how brutal was the fight in between?
Yes, and that snapshot of the psychological tug of war between supply and demand is exactly what makes it so useful.
This brings us back to that wild hook about the 1700s.
Ah, yes.
I was digging into the history in our sources, and this charting method wasn't invented by some Wall Street quantitative analyst in the 1980s.
Not at all.
According to historical texts and experts like Steve Neeson, who he really helped popularize this globally in modern times, it was actually developed by a Japanese rice merchant named Munehisa Homa.
Yes, Homa is basically a legend in this space.
Right. And he used it to track the prices of rice in Japan and published his findings in a 1755 book called The Fountain of Gold, The Three-Monkey Record of Money, which is an amazing title, by the way.
It really is an incredible piece of financial history.
But my question is, how does tracking rice prices from the 18th century actually help us understand modern, complex financial markets? How does that translate to currencies or derivatives today?
It works because while the financial instruments have changed entirely, human nature hasn't changed a bit.
Really?
Oh, yeah. Hama was trading in the Dojima Rice Exchange, which was essentially the world's first futures market. And he realized something profound. The price of rice wasn't just driven by supply and demand, like weather patterns and harvest yields.
Right.
It was heavily driven by the emotions of the merchants.
Because fear of a bad harvest would drive prices up faster than the actual bad harvest itself.
Exactly. Hama figured out that if he could visually map out the psychology of the market, like when merchants were overly greedy or overly fearful, he could predict reversals in the price.
That is brilliant.
He recognized that markets have memory and that traders react predictably when they're stressed. The reason a trader today can use the exact same visual tools on a highly complex currency derivative is because that derivative is still being traded by humans.
Or algorithms programmed by humans.
Exactly, reacting to the same basic impulses of fear and greed.
Okay, so a single candle tells us who won the day or who won that specific hour, but one day doesn't make a trend. What does it look like when the momentum actually shifts gears over a couple of days?
Well, that's where the patterns come in.
Right, because according to Wikipedia and other charting resources like Investopedia, there are 42 recognized candlestick patterns, split into simple and complex patterns. How do we actually use these to see a trend?
We are looking for momentum, and more importantly, we are looking for a loss of momentum. When you string these daily diary entries together, patterns emerge that historically indicate whether a market trend is going to continue or if it's about to reverse direction entirely.
Okay.
The most foundational example of this is a simple pattern called the doji.
Okay, spell that for me.
D-O-J-I.
Got it. And what does a doji actually look like?
Visually, it looks almost exactly like a plus sign or like a cross.
Oh, really? Just a cross?
Yeah, it forms when the opening price and the closing price are exactly the same or, incredibly close to each other.
So there's no real body to it then?
Exactly. Because they are the same, there is almost no real body to the candle, just a horizontal line with those wicks pointing up and down.
Wait, so if the wicks are long, it means the price went way up during the day and way down during the day, but by the time the bell rang, it ended exactly where it started.
You nailed it. And if we connect this to the bigger picture of market psychology, a doji represents total indecision.
Like a tug of war where nobody moves.
Exactly. The buyers pushed hard, the sellers pushed hard, but neither side could maintain control. It's a stalemate. If you see a stalemate after a long, aggressive winning streak by the buyers, it often means they are running out of steam.
So the market might be about to turn around and drop?
Yes, it's a massive warning sign.
That makes perfect sense.
Excellent.
What's another simple one we should know?
You should definitely know the hammer. This is a bullish reversal pattern.
Bullish meaning it indicates prices might be about to go up, right?
Exactly. The hammer forms when the price falls significantly during the day, creating a long, lower wick or shadow.
Okay.
But then it recovers to close near the high of the day, leaving a small, real body at the top.
So it literally looks like a hammer standing upright.
It really does.
Let me make sure I'm visualizing the actual market action here. Imagine panic selling at 9 a.m. Everyone is dumping the stock, driving the price down, which creates that long wick at the bottom. But then a massive buyer steps in at noon, acting like a brick wall. They absorb millions of shares, halt the panic, and physically drag the price all the way back up by 4 p.m. That action is what creates the hammer shape you're seeing.
That is exactly what happens on the trading floor. The sellers threw everything they had at the market, but the buyers completely overpowered them. That kind of strong, visceral rejection of lower prices often signals that a downward trend is ending and a new upward trend is beginning. The sellers are just exhausted.
All right, those are single candle patterns. But let's look at what happens when we start combining multiple candles. In our sources, there is a lot of focus on the bullish engulfing pattern.
Oh yeah, that's a classic.
Walk us through how that one actually forms.
The bullish engulfing pattern is a two-candle formation, and it's a very powerful indicator of a potential market reversal. Here is the exact formula. First, you need to be in a downward trend. The market has been falling for a while.
Okay, so a clear slide downward.
Right. Then, on day one of the pattern, you get a small bearish candle.
Meaning a filled red or black candle.
Exactly, where the close is below the open. It shows the sellers are still in control, but because the body is small, their momentum is maybe slowing down a bit.
Okay, so we're looking at a small red block at the bottom of a downward slide.
Spot on. Then comes day two. The second candle is a large bullish candle.
A hollow green one.
Right, where the close is significantly higher than the open. But here is the key defining rule. The real body of this second green candle must completely engulf the real body of the first red candle.
Oh, wow.
Yeah, the green body has to open lower than the previous day's close and close higher than the previous day's open. Visually, the second candle completely swallows the first one.
It makes me think of a sports team that is down by 10 points at halftime.
Okay, I like that.
There's a lot of doubt. The fans are quiet. That's day one, the small red candle. But then they come out in the second half, score 30 unanswered points, and pull off a massive upset. It completely shifts the psychological momentum of the entire stadium.
Yes, and the psychology behind that massive wave of confidence is undeniable. The sellers thought they still had control on day one.
But they didn't.
No, because on day two, an overwhelming wave of buying pressure enters the market, completely erasing the previous day's losses and then some.
Right.
When traders see a bullish engulfing pattern at the bottom of a downward trend, it is widely considered a strong buying opportunity because the shift in sentiment is so aggressive and visible.
But hold on. If we were just looking for shapes on a screen, aren't we just finding faces in the clouds?
Yes.
I mean, humans are kind of hardwired to look for patterns, even when things are totally random. Right?
You've just hit on the most critical vulnerability of candlestick charting. It's a psychological phenomenon called pareidolia.
Pareidolia. Like,
Right.
like when you look at a cloud and swear it looks exactly like a rabbit.
Exactly, or you see a face burnt into a piece of toast.
Right, yeah.
Your brain wants to make sense of random visual noise, so it forces a familiar pattern onto it. And the sources we're referencing, specifically Wikipedia and the CFA Institute, they're very quick to point out that candlestick analysis is highly susceptible to this.
So it's not an exact science.
Far from it. Reading these charts is highly subjective.
Even with all the algorithmic trading software out there today, I would imagine a computer doesn't see a face in a piece of toast.
True, modern charting software uses predefined algorithms and mathematical rules to try and highlight these patterns for you automatically.
Okay.
A computer program might flag a bullish engulfing pattern on your screen because the pixels perfectly match the formula. But the software often lacks broader context.
What kind of context?
Well, a pattern might look perfect mechanically, but if it appears in the middle of a sideways, choppy, low-volume market rather than at the bottom of a clear downward trend, it doesn't mean the same thing.
I see.
The human element of understanding the context is absolutely crucial.
So, as an investor, I'm already looking at earnings reports, debt sheets, profit margins, the fundamentals.
Right.
How do these candlestick patterns actually interact with that hard math?
Yeah.
How do you prevent yourself from just seeing what you want to see to justify a trade you already want to make?
That is the ultimate pitfall right there. Confirmation bias. You
Yeah.
really want to buy a stock, so you stare at the chart until you convince yourself that you see a hammer or an engulfing pattern.
Oh, totally. We've all been there.
The only way to protect yourself is by adhering to the golden rule of technical analysis. Never, ever rely on a single pattern in isolation.
So it's not a crystal ball.
Absolutely not. They
Yeah.
do not guarantee future performance. They must be combined with fundamental analysis.
Right, because if a company is fundamentally going bankrupt or they just lost their biggest client, it doesn't really matter what shapes are on the chart.
Precisely. If a company is failing, I don't care if the chart shows the most perfect bullish engulfing pattern in history, the stock is probably still going down.
Yeah.
Candlestick patterns tell you what the market is feeling about the fundamentals right now. But you still have to know what those fundamentals actually are. You have to combine the what and the when of the charts with the why of the fundamental business data.
So candlestick patterns are basically your dashboard warning lights.
I like that.
They tell you the engine is running hot or cold. They tell you if momentum is shifting, but you still need to look out the windshield at the fundamentals before you turn the wheel.
That's a great analogy. They give you the emotional temperature, but they don't replace the map.
Okay, we've covered a lot of ground today. Let's distill the key takeaways for you so you can actually start applying this knowledge. First, candlestick patterns provide a window into market sentiment. They visualize the daily battle between buyers and sellers, leaving emotional breadcrumbs for us to follow.
Yes.
Second, there are 42 recognized patterns, both simple and complex. We touched on 3 great starting points today. The doji, which signals a stalemate and indecision. The hammer, which signals a visceral rejection of lower prices and a potential price floor. And the bullish engulfing, which signals a massive psychological momentum shift.
All incredibly useful tools.
And third, they're only one part of a balanced analytical diet. They are subjective, they carry the risk of pareidolia, and they must be combined with fundamental research.
And if you want to start practicing how to spot these, because it really does take practice to train your eye to see the context, not just the shape, our sources today are excellent places to start.
Where should they look?
The CFA Institute and Investopedia have fantastic, detailed breakdowns of all 42 patterns, complete with visual examples. Wikipedia actually offers a really solid foundational overview of the math behind how modern charting software interprets these shapes. And if you want to dive deep into the philosophy and the history of this, look up the modern teachings of Steve Nason. He is widely credited with bringing these techniques to Western markets.
That's awesome.
You can also track down translated concepts from Munihisa Homa's original 18th century text, The Fountain of Gold. Reading about how an ancient rice merchant analyzed fear and greed will completely change how you view modern digital markets.
It really bridges the gap between raw data and human behavior. It just reminds you that there are real people with real emotions pressing those buy and sell buttons.
And I want to leave you with a final thought to mull over as you start looking at these charts yourself.
Okay, let's hear it.
We know that modern human traders and massive algorithmic trading computers are relying on the exact same 42 patterns that an 18th century Japanese rice merchant identified.
Right.
So the provocative question is this: does the market consistently move in these patterns because of hardwired natural human psychology that just never changes? Or do these patterns work today simply because millions of traders and algorithms are all looking for the exact same shapes at the exact same time, basically creating a giant self-fulfilling prophecy?
That is a fascinating question to leave you with.
It really makes you look at the charts differently, doesn't it?
That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.